Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Miguel Perez-Santalla, Vice President of Business Development at Bullion Vault, or as I like to say, Bullion Vault. No, just kidding. Miguel, thanks very much for coming back.
Hey, thanks for having me on again.
So we were talking recently. You said it's been a tough year in the metals business. Elaborate that.
Well, you know, you had the big collapse in the gold market, and then that took down silver, and silver got punished even more than gold. I think almost like another 15% more than gold did. And silver started to recover.
Right.
But you also had platinum and palladium, which not just the market, but the industry, you know, with this threat of strikes and the problems in the mining sector in South Africa. So all around, there's been like situations that have been causing a lot of stress for people in the industry, people who use the metals and consume the metals, not just the investment side of it.
But how does it look from the standpoint of supply? I mean, prices have come down. You talked about strikes or the threat of strikes. Where are we? Give us some sort of a snapshot in terms of supply. Is there an overhang, or are we at a deficit in terms of supply?
If we're talking about gold or silver, there's no deficit at the moment. There's plenty of supply of metal. What happened was there was some tightness and demand, immediate demand in Asia that was drawing metal out of the markets here. So they had a supply bars because there was a premium being paid there, so people could make money by taking the metal out of here and shipping it there, while the mines are still producing and the metal comes into the refiners again. So there's plenty of physical supply. One of the things that kept coming up, and you kept reading about it on the internet, was people saying, oh, the COMEX commitments are so large, and they're not going to be able to make the deliveries. But what they keep forgetting is, the great portion of the players are speculators on both sides of the market. So the buyers, just as much as the sellers, have to come up with the money.
Right.
So they're not going to come up with the money.
Yeah.
It's only a small percentage of deliveries that actually happen on the exchange.
But would you say, well, I guess you would use that as the counter argument to speculation driving prices. Basically what you're saying is like, look, there's two sides to that speculator story, right?
Well, the speculators are what adds liquidity to the market, and that's why the market was created way back in the 1850s in Chicago, was to give a two-way market that, the wheat producer could sell his stuff in advance at a good price and know what price he's working on. And that's what it exists for. And it enables us, industry users to buy and sell and protect their pricing and their products and know what to sell their products for. But the speculators do also drive the price, because when more people come in and they have leveraged investment into the market, it drives the demand.
And especially, I think, when you're talking about these large institutional and they're long-only passive investors, pension funds, endowments who want to own the commodity because they view it as an asset class, and they're not playing both sides like traditional speculators that you're talking about. They get in, they want whatever, 3%, 5% in their portfolio, and they'll buy that quantity and just hold on to it.
Right, and even there, it's very small percentage of those people that actually do that actually go into the physical and hold the physical. Gold is probably, if gold saw 1% uptick of investment from these fund managers, gold would go much higher.
Are you surprised by, there have been a lot of so-called very smart money managers, guys like John Paulson, even Soros, who bought into the whole hyperinflation, inflation thing from the money printing by central banks, and they bought gold way up, and that proved to be a very bad play.
Well, Paulson bought the whole way up, so he bought the whole way. So he made a lot of money too.
When not they according to the results of his funds.
His last one.
Yeah, his funds are way, way down.
But I think there's a lot of logic to that. Maybe sure they jumped in a lot when it was too high, but there's still a lot of logic behind that, because one of the things that's changing in the marketplace that I see is the currencies. In other words, as China grows and their GDP gets larger, the demand for their currency gets larger. Remember, a few years ago in 2009, they started to lift restrictions on demand and use trade of their currency.
Right.
So now they're expanding and becoming a competitive currency. Now, remember, one of the reasons the U.S. is strong is because of the size of our economy, our GDP, and because everybody needs a dollar to do business with us. But when we start losing that, that's the concern that I have. So I see a coming job war. In other words, we have to maintain our competitive edge and be creators. Otherwise, the GDP will keep shrinking and favoring China. And
yeah,
if
but
that
the
happens,
only way the rest of the world can rid itself of dollars, which is what you're kind of forecasting, is that they have to exchange those dollars for goods and services that we create. If they swap them among themselves, that supply of dollars stays out there, if you will. They could only, and that means our trade deficit goes down. We run a trade surplus. How can that be?
Yeah, but there's going to be a time of attrition where you start losing it in one way or another. I don't really know exactly how it's going to play out, but when they start growing, if we don't maintain our competitive edge, which I'm not saying we're going to lose it, because I still think that we have what's called a free-thinking economy, and that's why we have small business is the bread and butter of our country, and I think we will survive. But I still think we have a threat of shrinking at the moment, and that's where, as our GDP shrinks and our jobs don't grow, as we saw today in the non-farm payroll, then that's the concern I have, and I think that's what will support and hold gold. Yeah. I don't think gold's going to explode, but I think gold's going to hold a part in people's portfolio.
All right, so it sounds like, and this has historically been the case with most commodities, you get this period where it kind of goes to a new equilibrium level, and then it stays there in some trading range for a long period of time. Yes. Is that what you're saying?
That's what I feel. I expect that we could see, there's some people that think gold could go as low as 900. I think more 1100 is the bottom, and so I would say 1100 to 1600 is going to be this, like 1600 the high, super high. But we're going to be drifting either lower or higher depending on the world economy.
So a little bit cautious into this recent rally.
Yes.
All right.
I would buy dips. That's the way I look at it.
Buy dips.
Yeah.
Miguel Perez-Santalla, always a pleasure to have you.
All right. Thank you for having me.
Pleasure. That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.